Thanks for clicking. The United States could be heading for a repeat of 1970s-style stagflation, high unemployment coupled with high inflation. This according to Jamie Dimon, CEO of JPMorgan Chase, America's biggest bank, who has been called the most powerful banker in the world. For his part, Dimon was also stockpiling cash and warning of higher rates and higher inflation back in June of 2021, back when our own titans of economic history were pushing variable rates to anyone they could.
You got lucky.
Dimon's comments come amid the release of U.S. GDP data showing a weakening economy and accelerating inflation, leading to renewed fears of something we've been talking about on this channel since 2022, the risk of stagflation. And we're not used to hearing this type of talk coming from a banker here in Canada, as our banks tend to predict lower rates and higher real estate prices ad infinitum to the moon forever.
And there's no reason to doubt that.
Are you drunk?
As such, given that banks tend to do better when interest rates are lower, I think it's worth taking a closer look when a banker discusses possibilities that may not exactly be in its interest. So what I want to do today is go over Jamie Dimon's interview with the Wall Street Journal, take a look at his comments on stagflation, discuss the potential for stagflation coming to the United States and obviously here in Canada, and then go over some implications. As we'll see today, and as we've talked about so much on this channel, the story coming out of the United States is an ongoing one, which will no doubt have a direct impact on the economic trajectory here in Canada. We'll obviously continue to have updates out on that trajectory on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into stagflation. First off, a very brief review of stagflation as we've gone over it at great length on this channel. Stagflation, by definition, is slow growth, high unemployment, and high inflation. We saw stagflation most famously in the 1970s when high government deficits, lower interest rates, and high oil prices sent unemployment and inflation skyrocketing higher. At the time, U.S. deficit to GDP had been running much lower than it was pre-1970s. We saw a big interest rate drop following the first oil shock in 1973. We had two big oil shocks in the mid to and late 1970s. And the money supply was increasing at a rate not seen again until the pandemic, ultimately leading to high inflation and high unemployment, or stagflation. So, the 1970s saw high deficits, high government spending, and the oil shocks send employment and inflation higher. Not to mention a major increase in the money supply in the 4 years prior to those shocks.
I don't know where you're going with this.
Well, first and foremost, stagflation is a real problem for policymakers, as usually, if unemployment is low, policymakers can lower interest rates, increase the spending, and unemployment moves down. But you can't do that if inflation is already high, as any more stimulative policy coming out of the government, coming out of the central bank, will just send inflation even higher.
You don't f***ing know that!
So policymakers end up with a conundrum. Do they save the economy and tank the currency, or do they tank the economy and save the currency? Tackle inflation. In the 1970s and early 1980s, as everyone outside of the real estate industry knows, policymakers chose the currency, ultimately raising rates to double digits, reducing the money supply, which put a lid on inflation. And it wasn't just in the United States. As we all know from any discussion from anyone that purchased a home in the 1980s, interest rates skyrocketed here as well.
You got a good life. A good life.
And Jamie Dimon says that the worry that we could be returning to 1970s-style stagflation has been on his radar as of recent.
Just a little cautious. It looks a little bit more like the 70s to me.
So the question becomes, why? Dimon even noted at the beginning of his interview that U.S. consumer data, the data that we've seen so far, makes it look like the economy in the United States is doing fairly well.
Consumers in pretty good shape right now. Unemployment's under 4%, has been there for 2 years. Housing prices are up, stock prices are up, jobs are plentiful, wages are finally going up at the low end. The consumer's in pretty good shape.
And yeah, all of that is true. We've seen article after article over the past few months showing how well the U.S. economy is performing relative to its peers, with even TD noting the exceptionalism of the United States economy, with nary a mention of the U.S. deficit or U.S. borrowing. Though TD did take time to let us know that 100 basis points of rate cuts are coming in 2024, and that Canada shouldn't be including the cost of money in its inflationary metrics, adding credence to why we look outside the country for non-biased analysis. But I digress. Dimon noted in the interview that although the U.S. economy appears to be doing quite well, Most of that growth is spurred by debt, by fiscal spending.
A lot of it is driven by just fiscal spending. So even today, the deficit is 6% of GDP, almost $2 trillion. That's driving a lot of this growth, and that will have other consequences possibly down the road, called inflation, which may not go away like people expect.
And yeah, U.S. deficit spending is now close to $2 trillion, meaning the United States is spending $2 trillion more per year than it is bringing in. Further, deficit to GDP, which we spoke about earlier, is even worse than it was in the 1970s preceding stagflation. And while we shouldn't have to go over why deficit spending is in fact inflationary, in a world where experts tell us that we can shut down the global economy, print $13 trillion, and nothing bad is going to happen, it's briefly worth going over the mechanics.
When am I ever going to use it?
When governments spend more money than they tax, when they spend more than they bring in, that introduces more money into the economy. And if the economy is already running hot, if that money is added into the economy that's already near full employment, that has the potential for sending prices upward. Now, some, you-know-who, will argue that the US had major deficit spending in 2008 and 2009, but we didn't see inflation. And that's true, but the US also saw its employment rate nearing 10% during that same period. And inflation was already low at the time. As noted by the Congressional Research Service, when government spend and unemployment is already high, it's doing that spending to bring the employment back to full employment, to bring unemployment back down to 3 or 4%. However, when government spend past full employment, or when unemployment is already low, that has the potential for inflation. As with anything, context matters. And Dimon is not alone in the worries about deficit-induced inflation, with the IMF just last week issuing a report noting that U.S. spending and burgeoning debt risks reigniting inflation and ratcheting up global funding costs. As such, the IMF says that the U.S. could raise the borrowing costs for everyone else, which would make its way into the price of goods and services. And as such, Dimon argued that rates could have to go up even higher than they are right now.
When I look at the range of possible outcomes, you can have that soft landing. I'm a little more worried that it may not be so soft and inflation may not quite go away people expect. I'm not talking about just this year. I'm talking about 25 and 26. The rates may have to go up a little higher. I'm talking about the 10-year rate, the 5-year rate. And that can have consequences.
And yeah, if inflation is in fact on its way up, the Federal Reserve may have to raise rates higher than they are right now, with a chorus of voices emerging over the past few weeks saying that that could in fact be the case. But it's not just deficits and the cost of borrowing that could send inflation higher, with Dimon noting that there are risks abound which could send inflation upward over the next 1, 2, 3 years.
Huge amount of fiscal deficit, huge amount of QE, a lot of things in the future inflationary, the green economy, the remilitarization of the world, obviously the deficits, which basically aren't going to go away as far as the eye can see, and geopolitics. All that puts me on the side of caution that things may not go as well as people expect.
And yeah, that makes sense. Inflation is obviously ticking up in the United States, and we've all seen what current geopolitical uncertainties have been doing to oil prices. And although I do try to avoid hyperbole, we're talking about the Middle East, where it wouldn't take much to send oil prices higher, with even the World Bank, as of recent, noting that oil could reach $100 if the conflict increases. Now, that's not as big of an increase as we saw during the oil shocks in the 1970s, but still an increase and a substantial one nonetheless. All of these inflationary risks, all of these inflationary scenarios that are at least somewhat similar to the 1970s, come amid the United States economy showing signs of weakness. So, deficit to GDP, worse than it was in the 1970s. We obviously had the lower interest rates. Oil prices could very well be on their way up. And what about the money supply? Well, it's not really rising, but it's not shrinking anymore either. Still at $5 trillion higher than it was pre-pandemic. So we have high deficit spending, $5 trillion still floating around. We have the potential for major oil shocks, and an economy that looks good on paper, but one that is propped up by that major fiscal spending. As such, Dimon is stressing caution.
As a business person, I try to be prepared for all of that. Just a little cautious. It looks a little bit more like the 70s to me. And I point out to a lot of people, things look pretty rosy in 1972. They were not rosy in 1973. So don't get lulled into a false sense of security because the today looks okay, that tomorrow's going to be okay.
Yeah, And a lot of those factors which has Dimon so worried about stagflation coming to the United States are present here in Canada as well. Oil shocks, weakening economy, and all of that printed money still floating around. Though, relative to the United States, our deficit to GDP isn't nearly as troublesome, though that's even being offset by a lack of productivity. So, is stagflation something that is going to happen tomorrow? Probably not. Dimon says that this is on his radar for 2025, 2026, and beyond. These are ongoing events. These are ongoing problems. As Dimon says, it looks as though there is no end in sight for U.S. deficit spending, and the Middle East remains uncertain as it's ever been. Whether or not the U.S. will see continued economic weakness combined with continued inflation remains to be seen. But we will obviously continue to track this story on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.